In this episode of the Investing Expat, I would like to go over a checklist of some year-end items that you want to look at if you are a US taxpayer, whether you live in the United States or outside of the United States. First of all, a very important disclaimer. This recording is for educational purposes only and should not be considered advice of any kind. The first thing that I often check towards the end of the year is tax loss harvesting. So this is opportunities to sell any stock, any fund, even any bond that you have at a loss that you can now sell for less than when you purchased it. The main reason to do that is that these losses can be used to offset any gains that you may have on other things that you've sold this year. Or up to $3,000 of these gains can be used to offset your earned income as a regular tax deduction. So now that we're in December, let's take a look and see if you can get any of those tax losses. A second thing to check for are opportunities for Roth conversions. In order to have your Roth conversion completed and pay the tax in 2023, you need to get this Roth conversion done by December 31st. What that means is that you'll be paying tax on this amount of money you move over this year, but you'll put it in an account which should hopefully be tax-free with all the gains for many, many more years to come. Putting something into a Roth is also very important if you're preparing for required minimum distributions, RMDs, which we'll be discussing next, because under current law, Roth IRAs are not subject to RMDs the way that traditional IRAs and 401ks are. Third item is to check for RMDs, check for those required minimum distributions. This really matters when you were born. If you were born before 1951, you should already be taking RMDs. If you were born between 1951 and 1959, you need to start taking these RMDs, these required minimum distributions, from age 73. And for those of you like me who were born in 1960 or later, we don't have to worry about RMDs until the age of 75. But this is something important to keep in mind, whether you need to take these RMDs this year or whether you need to look ahead for the next few years and prepare for those RMDs so that you don't get a surprise tax bill. Number 4 on the checklist is to make any 401k employee contributions. So unlike your IRA, which where you have until April 15th of next year to decide how much you want to contribute for 2023, for any 401k employee contributions, you need to make those by the end of this year for them to count towards your 2023 limits, and for non-Roth contributions for them to be deductible in 2023. So this is relevant if you have a 401k plan and can make those adjustments. This is your last month to do so. Item number 5 on my checklist is gifts to family. Now, this is very important, especially for Americans who live outside the United States and have family members that are non-US persons and not subject to US tax and want to get assets out of our tax net and out of the hands of Uncle Sam. In 2023, the amount that you can gift to a non-US spouse, so if you are married to a non-American citizen, a non-American taxpayer, you can give up to $175,000 to that non-US spouse for 2023, and that's scheduled to keep going up in 2024. To anyone else, you can give up to $17,000 as your annual gift exclusion for 2023. Now remember, this $17,000 gift limit includes contributions made to 529 plans, say for the benefit of your children, grandchildren, or anyone else. But one special rule with 529 plans is that you can front load your 529 contributions. So you can contribute up to 5 times $17,000 for one child and have that count as your gift for the next 5 years. So something else to keep in mind if you want to use your $17,000 exclusion for any children or family members you want to give a gift to. And 6th and finally on this particular list is gifts to charity. So if you want to take the charitable deduction in 2023, your gift needs to be completed by December 31st. And you also want to keep in mind, this is something you want to plan for if you have a bunch of charitable contributions and you want to bunch them into a year so that they're significantly greater than your standard deduction. So since the increase in the standard deduction, the common strategy for charitable giving is, instead of giving smaller amounts every year, we bundle a lot of our gifts into 1 year and then take the deduction 1 year, and then we can take the standard deduction in other years. If you need help bundling those, if you say, for example, you don't want to decide on the charity right away, Using a donor advised fund is a great way, especially to donate an appreciated asset. If you have a stock or a cryptocurrency or some other asset that's gone up a lot since you bought it, you don't want to pay capital gains tax on it, but you'd eventually like to donate it to charity, you can donate it to a donor advised fund or charitable remainder trust to get that deduction this year, and then invest the proceeds and defer your choices of charities to later on. So if you've got any more questions about what to do either for year-end 2023 or going into 2024, you can contact me either on Twitter, now known as X, by the handle Investing Expat. You can search for me on LinkedIn as Tarek Dennison, T-A-R-I-Q, last name Dennison, or you can contact us on our website, gfmasset.com/contact. Thanks for joining us, and we'll be uploading more episodes of the Investing Expat shortly.